Imagine waking up tomorrow morning. You grab your phone, load up your banking app, and nothing. The screen's just frozen, right? So you rush down to the local branch, but the heavy glass doors are completely dead-bolted. There's just a stark white paper sign taped to the window. And then the news alerts start blowing up your screen. Your bank has failed. Suddenly, this terrifying, visceral question hits you like a ton of bricks. Where is your money? Did you literally just lose everything? Is your rent check gonna bounce? In a world where our entire financial lives are essentially just numbers on a screen, what actually happens when those servers go dark and the bank completely collapses? Okay, let's dive right into this explainer when the bank disappears. We're going to pull back the curtain on the hidden mechanics of the American financial system and separate the Hollywood myths from the very real, very strict rules that actually govern your cash. Because the truth is, this system is designed for this exact nightmare scenario, but if you don't understand the hard boundaries of that system, you could wake up to a very expensive reality. First things first, we absolutely have to shatter a massive illusion. When a bank fails, it's almost never because some masked villain pulled off a heist and emptied a giant steel vault of all its paper bills. That's just the movies. Modern banks do not keep everyone's cash just sitting around in a safe collecting dust. They take your deposits and they put them to work, funding mortgages, giving out business loans, and investing in financial assets. What that means is a bank can literally own billions in assets, but if they lack the immediate on-hand cash to meet a sudden wave of withdrawals, well, they collapse. And that's when the regulators step in. And that is precisely when the hero of our financial thriller steps out of the shadows. Enter the FDIC, or the Federal Deposit Insurance Corporation. This is the U.S. government agency specifically built from the ground up to catch you when the floor falls out from under your bank. Their core mission is beautifully simple, really. Protect insured depositors when an insured bank goes under. But you've got to pay very close attention to that word, insured. Just because you have an account at a bank absolutely does not mean every single dollar to your name is protected by some magic federal shield. There are very strict rules. And the whole thing really starts with one critically important number, $250,000. Seriously, burn this number into your memory. The standard FDIC insurance limit is exactly $250,000 per depositor per FDIC-insured bank for each ownership category. Now, I know that sounds pretty straightforward, right? But the way this rule is actually applied in the real world is exactly where millions of Americans leave themselves completely exposed without even realizing it. Now, what's really interesting here is the trap so many people fall into. Let's say you've been a super diligent saver. You've got $100,000 sitting in your everyday checking account, you've got another $100,000 tucked away safely in a savings account, and let's say another $100,000 locked into a CD, a certificate of deposit. All of these are sitting at the exact same FDIC-insured bank. Most people would look at the setup and think, awesome, 3 separate accounts, so I've got 3 separate $250,000 safety nets. But here is the kicker. The FDIC does not care how many separate accounts you've opened. If those accounts are all owned by just you, in the exact same ownership category, say just standard single accounts in your name, they are combined, lumped right together. So let's do the math on that. You have $300,000 in total deposits, but the insurance limit maxes out at $250,000. That leaves $50,000 completely 100% uninsured. If that bank's doors lock tomorrow, that 50 grand is just floating out there outside the federal safety net. It is kind of terrifying when you realize that simply opening more accounts at the exact same branch does absolutely nothing to multiply your armor. And honestly, the traps don't stop there. Just because you buy something inside a fancy bank building or tap a button on your bank's app does not mean the FDIC protects it. Checking accounts, savings accounts, CDs, yeah, for sure, those are eligible bank deposits. But what about those mutual funds your bank's advisor sold you? Or the stocks, the bonds, maybe even the crypto assets you hold through their shiny platform? No way. Those are completely uninsured. Investments carry their own risks, and the government is definitely not going to bail out your stock portfolio just because your bank's servers went dark. So, you're probably wondering, how on earth do you actually protect wealth that exceeds $250,000? Well, it's all about strategic structuring. You see, FDIC coverage applies completely separately across different ownership categories. Think a single account for just you versus a joint account with your spouse. Those are different buckets. Plus, certain retirement accounts and qualifying trust arrangements get their own separate buckets of coverage too. Or, an incredibly simple fix, just spread your money across completely different, totally unaffiliated banks, and boom, your safety net instantly expands. But let's play devil's advocate. What happens if you make a mistake? What if you actually have uninsured cash trapped inside a collapsed bank? Do you just wake up and instantly lose it all? Well, not necessarily. But your status immediately drastically changes. You lose that automatic federal protection. Instead, you basically become a claimant in the failed bank's receivership. So as the government comes in and liquidates the bank's assets, literally selling off its loans, its real estate, right down to the office chairs, you essentially just have to wait in line for distributions. You might eventually recover some of that money, sure, but that ironclad federal guarantee? Yeah, that vanishes completely. All right, let's pull back to the sheer chaos of the actual collapse. Let's put you right smack in the middle of it. It's Friday afternoon, the financial news networks on TV are just flashing red. Wall Street is completely frantic. Regulators officially step in and seize your bank. Your heart is pounding. You're probably thinking, is my money going to be frozen in some endless bureaucratic nightmare for the next 10 years? Well, surprise. What actually follows is this highly choreographed, almost sterile government procedure that is designed specifically to make you feel as little disruption as humanly possible. The FDIC is immediately appointed as the receiver. And over the weekend, right while the general public is panicking, the FDIC is working frantically behind closed doors to orchestrate a rescue. Usually, they'll arrange a deal where a healthy bank steps in and acquires the failed one. So come Monday morning, you just magically become a customer of the new healthy bank. Your insured deposits transfer absolutely seamlessly. And if they can't find a buyer, the FDIC just pays insured depositors directly, literally cutting checks for your protected balance. The entire goal is speed and absolute total order. Now, I gotta do a quick reality check for anyone hoping a bank failure is like some secret lottery ticket. If your bank goes under and you happen to hold a mortgage, a car loan, or a massive credit card balance with them, I have some really bad news. Your debt does not magically disappear into the ether. Sorry, a bank failure doesn't just erase your financial obligations. Those loans are actually considered assets of the failed bank. So during that frantic weekend resolution process we just talked about, your debt is simply packaged up and sold or transferred right over to a new institution. You still owe every single penny, it's just to a different name on the letterhead. And by the way, this seamless transfer system is exactly why you shouldn't panic about your everyday financial life. You might be stressing, what about my Friday paycheck or my rent? Well, because of this highly structured resolution, your automated payments and direct deposits usually continue without a single hitch. If your accounts are transferred to an acquiring bank, it's just business as usual. Literally, the absolute worst thing you can do in this scenario is panic and start wildly shifting money around based on some crazy internet rumors. Just take a breath, wait for, and strictly follow the official instructions from the FDIC. And this brilliantly illustrates one of the most dangerous, widespread myths in modern finance, the assumption that sheer size equals safety. You hear it all the time. Oh, my bank is huge, it's a household name, they literally sponsor a football stadium, so my money must be completely safe. That is absolutely the wrong question to ask. A towering, shiny skyscraper in Manhattan and a recognizable logo do absolutely nothing to dictate your coverage. The only two questions that actually matter are, 1, is the bank FDIC insured? And 2, exactly how does your cash align with those ownership category rules? Because trust me, when real panic sets in, size isn't going to stop a bank run. And a bank run is the ultimate cinematic financial nightmare. It happens when fear literally goes viral and massive crowds of customers all demand their money at the exact same time. And remember what we said earlier? The bank doesn't actually hold all that cash in a physical vault. In our modern age of smartphones, social media echo chambers, and instant wire transfers, a single rumor can spark a digital bank run that drains billions, with a B, of dollars in a matter of hours, completely crushing a bank's liquidity. This right here is exactly why deposit insurance exists in the first place. It's not just to pay you out after the fact, it's to create deep psychological confidence. Because if you know for a fact you are insured, you don't panic, and you don't run. And look, this isn't just some abstract theory from a dusty old economics textbook. We literally just lived through this. The 2023 bank failures sent massive shockwaves through the entire financial world, taking down colossal institutions in a matter of days. It was a very stark, very modern warning that our banking system, as highly regulated as it is, has hard, unforgiving boundaries. Those failures proved beyond a shadow of a doubt that understanding the difference between your insured bank balance and your uninsured assets is literally what separates the people who sleep soundly during a crisis from the people who lose everything. But you don't have to live in paranoia. You really don't. You just need a blueprint. Let's break it down into 5 steps. 1. Verify your bank is actually FDIC insured. 2. Track your exact cash balances at each institution. 3. Understand your specific ownership categories. Are they joint, single, trust? 4. Know exactly which products in your portfolio are eligible deposits and which are uninsured investments. And 5. If you're lucky enough to have more than $250,000 in cash, whatever you do not ignore it. Structure it strategically across different categories or entirely different institutions. Take control of your money. So it all comes down to this one ultimate question. If your banking app goes dark tomorrow morning, if the local branch doors are padlocked and the news alerts are just screaming red, how much of your money is actually protected? Financial security isn't about blindly assuming the system is never going to break. It's about fully, deeply understanding the mechanics of what happens when it does. The time to learn the rules of this game is not after the crisis has already started. If this explainer changed the way you look at your checking account, just know that understanding these hidden mechanics is the single greatest advantage you can possibly give yourself. Because the more you understand how the system works, the harder it becomes for the system to work against you. All right, before we wrap up today, we're going to do things a little differently. Normally, I'm the one behind the scenes digging through all the macroeconomic data and picking out the topics we cover. But today we're handing the keys over to you. We're kicking off a massive community challenge right now, and the power to choose the exact subject of our very next explainer is entirely yours. So here's the deal. Our target is 100,000. If this explainer hits exactly 100,000 likes, I'm fully committing to doing our next deep dive on literally whatever topic you guys want. I know, 100,000 is a huge milestone. It's ambitious for sure. But I also know this community. You're highly engaged, you're deeply analytical, and honestly, I think you're totally up for the challenge. So what exactly is on the table? Well, pretty much anything. We could get into the weeds of the banking sector, look at the actual psychology and utility of money, or break down complex investing and business strategies. Or, hey, maybe you want us to dissect the absolute wild west of AI right now, or just zoom way out and analyze the broader macroeconomic picture of the economy as a whole. Honestly, you're completely in the driver's seat here. Whatever complex system or sector you want broken down logically, you name it, you decide. Okay, so to actually cast your vote and make this happen, here is your clear 3-step game plan. Step 1, just hit that like button to help push us toward that massive 100,000 goal. Step 2, make sure you're subscribed to the channel. That way you're notified the absolute second the results drop. And step 3, the most important one, head down to the comments right now and tell me exactly what topic you want to see next. The bottom line is really simple. 100,000 likes equals your topic next. The choice is completely in your hands. So let's get this explainer to that milestone. I absolutely cannot wait to jump into the comments and see what kind of incredible high-level ideas you guys bring to the table. So what complex system should we demystify next? Get to